Hi, this is Mr. Evans. This video looks at net present value as a method of investment appraisal, which is one of the three methods that you need to be aware of. So investment appraisal, what we're doing, we're looking at businesses spending money on something and trying to work out if that investment is going to be financially viable. For example, a business might want to know if it should expand overseas, engage in a marketing campaign, build a new factory somewhere. Okay, all of these are projects that you could analyse to be using investment appraisal to see if they're financially viable or not. The methods that we've looked at so far are payback, which calculates when an initial investment is going to be paid back, so it considers timing, and average rate of return considers the lifetime profitability of a project. How much money does this return on average each year on our initial investment? Now, net present value, which is the final one that you need to be aware of, the final method of investment appraisal, combines an assessment of both the timing of the cash flow, so that element of timing with payback, and the overall profitability of a project, so combining those two features of payback and average rate of return. So to define net present value, we could say that net present value calculates the value of expected returns of a project in today's money, basically, calculating the expected returns of a project in today's terms. So what do I mean by that? Well, money today is worth more than money in the future. By that I mean that if I have £100 today, and I spend it on a certain amount of goods and services, in a year's time, that £100 will not buy the same quantity of goods and services as it will today. That's because of inflation. The other thing I could do with that £100 is I could put it in a bank account, and if I choose to invest it, I'm going to lose that potential interest. Okay, so the combined impact of lost interest for the opportunity cost of making an investment, and the impact of inflation eroding the value of money, meaning I can't buy as much in the future, means that money today will buy more than the same amount of money in the future. So a discounted cash flow attempts to calculate the real value of money received in the future. In other words, the value of money in the future in today's terms, what that money would buy me today if I had that money now. How much would that, if I'm going to receive £1,000 in 2 years' time, well, that £1,000 won't buy me the same amount as £1,000 will today. So how much is that actually worth in today's money? It's going to be worth less because it will buy me fewer goods and services in the future. So let's have a look at how to calculate it. Well, first of all, you'll notice this is the information that we're given for a Buzz 3 question. First thing you'll notice is the table, and then you see that we are given discount factors. Okay, so we're going to use the discount factors to calculate net present value. There are two steps involved in it. First of all, we multiply the net cash flow by the relevant discount figure, which will be given to you. And then we need to add up the net present value to give the total return on investment. So let's just show you an example. So all I've done is I've taken the information that we've already calculated. The cash inflows and outflows were given to us. The net cash flow is simply subtracting the outflows from the inflows. And I've added this discount factor column, which uses the information that we're given here. Of course, in this case, £500 million today is worth £500 million in present money, so the discount factor is 1. £500 million today is 100% £500 million in the future. However, using this discount factor, we can see that we're going to get £145 million on net cash flow in year 1, but it's only going to be worth 95% of what that money is worth today. So it's only going to buy me 95% of the goods and services that I can buy today. It's worth, if I had 145 million today, I'd be able to buy 5% more goods and services than I can buy a year down the road. So how much is that 145 million actually worth today? Well, I times it by 0.95, and that tells me that it's actually worth 137.75 in today's money. Now you can do the remaining calculations for the remaining years of the project. So in year 2 we're going to get 217.5 million, but that's only worth 90% in 2 years' time of what 217.5 million would be worth today. So it's actually worth less, and you can calculate that. Again, 265 million in 3 years' time sounds good, but it's only worth 86% of what it would be today. When you've got those, you can total the figures up. You might want to pause the video and do so now. And hopefully you have come up with these figures. Okay, so when we start off with minus 500 and we add these numbers to it, we see that the project comes out with a net present value of £61.4 million. In other words, because it's positive, this is a profitable project. So how do we calculate that? Well, I've just mentioned, because we're coming out with a positive figure of 61.4 million, we know that this project should be profitable if our figures are correct. A project that brings in more cash in the near future is likely to be more valuable than one that brings in cash later on. So because these discount figures, because money gets less valuable the further you go into the future, it's better to get more money today. So projects that bring in more money in the near future are likely to be more valuable than projects that bring in a lot of cash later on. And we can do a number of calculations to consider the potential impact of, say, changes in the interest rate. For example, I'm recording this in September 2017, and the Bank of England has seemed to have changed its tune on interest rates and interest rate rises. They're currently 0.5%, which is very, very low. And many people weren't expecting them to go up for a while, but in recent weeks the Bank of England seems to indicate that interest rates will change. And so if a business were doing this, they could play with that. They could say, what's going to happen if there's a 1% interest rate, a 2% interest rate, a 5% interest rate, and we can calculate the net present value based on those different interest rates. So the pros of net present value, well, it's going to take into account the opportunity cost of keeping the money into a bank, so we can compare the value of an investment with what we'd get if we just put the money into a bank. And because, of course, we want to reward for our risk, investment is risky, putting money in the bank is relatively safe, we can see if we're getting rewarded for the risk of an investment. It considers both the timing and the profitability of a project, and can be used to consider different scenarios, such as interest rates going up, or what happens if we get money later rather than earlier. How will that affect the overall profitability of a project? However, the cons of net present value, well, it's difficult to know what discount rate to use. Interest rates and inflation both change over time, and it's very difficult to predict what's going to happen with them. And also it's slightly more time consuming to calculate than the other methods, particularly if we're going to play with timings of figures and different interest rates and discount rates. But investment appraisal net present value is the most complex one you need to calculate, so get plenty of practice in doing so.